So I'll go ahead and introduce myself just very briefly. My name is Nate Wiggum. My firm is Ian Capital. We do general commercial real estate capital advisory, so really debt and equity placement across all parts of the capital stack, all property types all over the country. And I've been doing this since 2006 and am pushing about $1 billion of transactions I've touched in one way or another. So that's the quick rundown of myself. Let's go ahead and introduce the other panelists. So, Joe, if you're on, you want to go ahead and introduce yourself?
Sure, I just need another second as we're warming up. You want to just come round back to me in a moment?
Sure thing. Let's see here. Do we have everyone else on there?
Dr. Singani, are you with us?
Okay, thanks.
Euclid's on.
All right. Euclid, you want to introduce yourself?
Hello, how are you?
Euclid, we can hear you. We're good.
Perfect.
All right, Euclid, you mind giving everyone your quick intro?
Yeah, so Euclid Walker, I am Senior Managing Director and Partner at CGI Merchant Group, a Miami headquartered real estate private equity firm with offices in Miami, Palm Beach, New York, and Toronto. We recently launched a $650 million hotel fund focused on buying hotels opportunistically across North America and the Caribbean. And we have an exclusive partnership with Hilton and a focus on ESG conscious consumers.
Great. All right, I think, Doc, you just joined us?
Yes, sir.
Great. All right. Well, you're right on time. Do you mind giving everyone your brief intro?
Yes, sorry about having some little technical difficulties, but I'm on. My name is Dr. Bharat Singhani. I'm a cardiologist and by accident got into hotels, and I'm here with you. I represent Encore Enterprises, which is about 30 plus year old company, and we do multiple businesses, but for today's session primarily started as a hospitality company, portfolio roughly about $1.5 billion. We own and manage, own majority of it, and love to be here today.
Great. Thank you, Doc. All right, Joe, I think you're up.
Hey, Joseph DiMatteo here, President and Chief Executive Officer of JDM Capital Hospitality and JDM Capital Corp. Our firm has been around for the past 18 years with the core focus over the past 7 in hospitality and high-end residential components of hospitality. And we are looking forward to today's discussion. We're active generally in select service and above assets, and everything from luxury brands to boutique and full service only. We're not really a limited service player, and we look at assets within the confines of the US, and we're entering into some interesting opportunities in the EU in the past few months. So that's a new development for us, that we've looked at things before in the past, but we see some opportunities there what we haven't seen before.
Great. All right, thank you, Joe. Okay, so I think that's everyone. Obviously, we're here to talk about the opportunities in distressed hospitality, and in preparation for this, do a little research, and I read American Hotel and Lodging Association's 2021 report. And one thing that they mentioned in there that really jumped out at me is that apparently the hospitality industry has been affected by COVID 9 times more than it was by 9/11. So I think that really puts things into perspective. So I think, just kind of kick off this conversation, a good place to start would be just kind of generally speaking, how do you guys feel about the recovery of the industry relative to leisure or business travel?
Great question. I'll start if that's okay.
Please.
So it's interesting. We are seeing a lot of pent-up demand, clearly, especially as the vaccines get rolling out on the more consumer-focused leisure travel. And we believe that that's going to come back much more quickly than business travel. There is historically a lag of, call it 12 to 18 months for events and meetings and conferences to get scheduled, and nothing's being scheduled right now. So if we look at bookings in the hotels that we currently have, it's an empty sheet. So business travel is going to come back much more slowly, and that's a big driver for occupancy and ADR. So it's probably the leisure travel will come back more quickly, but the business travel's lag is going to create a lag in performance for at least the next, call it 24 months would be my guess.
So I think it's interesting that as we're starting to see the vaccines roll out, it sounds like you have not seen any business bookings even in anticipation of that.
We're not. I don't know if any other panelists are.
No, from our experience, the booking window is virtually non-existent. It's gone from a year or two over a broader span of many years to within 6 to 8 months, 6 months to a year. To before COVID, it was already shrinking, mainly because it was already a variance happening in group bookings and a reduction of that prior to even COVID occurring. And now it's, you went from, in the month, for the month, to it could be in the week, for the week, in the day, for the day. And it's putting a lot of pressure and stress on operations in order to be able to manage that, not only just profitably, but from a guest expectation point of view, while still holding COVID standards. We found that a lot of that, a change in the booking window and expectations of when people are coming, they're kind of running away from things to a certain extent, especially for our property in Florida, that we see people coming in. And I think that the anticipation of daily house cleaning, with the new COVID standards, are a challenge for guests to swallow and accept. I think that doubles down for the challenges of operations to be able to handle on-call, room shuffling, downtime in between room occupancy, and having the proper staffing on a consistent basis. So it's a struggle for, I think, the ultimate guest's experience at this moment as things start to travel down. And I think that from a profitability point of view, it is also challenging because of the shifts and changes in staffing, of whether you're running your core staff too hard or your interim staff is not up to speed, trained, or realistically dedicated as you'd like them to be.
Right.
No,
So-
I do agree. Theoretically, what Euclid and Joe both are saying, and I've known Joe for a while now, so I have a lot of respect on what he says. And Euclid and I were on the call the other day, and he has done some amazing things. One can subdivide that a little bit more and go where the drive to markets, right? And then there are the limited service in industry. So those will do much better because they really don't need that kind of conventional businesses to do that well. And then let me tell you something. We all have a difficult time. We had a difficult time foreseeing what COVID would do, and now it is behind us. I think we still have a difficult time seeing what without COVID will look like. and we still are in that mindset, but I have a feeling that everything is under spring constraint. And as soon as these vaccines, I mean, 110 million vaccines have been, I'm a physician, as most of you know, I'm following that much more closely. And that's maybe I can bring little bit different viewpoint to this, that the fear is already receding. I mean, people are coming to see me and they're throwing the mask away. Not necessarily that I agree with that, but I'm just saying that the fear before, nobody would come see me without wearing a whole hazmat suit. And now they're doing so. I think before we even get there, the spring is unloading. And then even though normally we would like things on the booking 12 to 16 months ahead, I don't really, I won't be surprised if that picks up a little faster. So I'm a little bit more optimistic. I'm definitely optimistic for the select service, for the full service, and we have some of those. I'm still a little bit more optimistic than CoStar is saying something, or Star Report is saying something, or most of the people are saying something. I think we'll do a much faster rebound starting probably last quarter this year. But again, this is just, I don't have any crystal ball. I'm just thinking in terms of the reaction I'm seeing. And I live in Texas. I'm telling you, we went there yesterday for a dinner, and there was not a single space that was open for us to go there because it's fully open. And I couldn't believe that this place was 10% and we couldn't, nobody would want to go there. So just my 2 cents.
So Doc, kind of following that thread, if you had a crystal ball, when do you think you were going to see pre-COVID occupancy again?
So right now we have divided our things into two: select service and the full service. The select service, we are almost at 55% occupancy, and we were across throughout forget the March, but starting April we started picking up, and we've been running about 50% for the past several months. We are 55% in February and April. So in my books, I think we will be break even. We are losing money right now, of course, but we'll be break even in the third quarter of this year, and everybody's looking for that number, right? So I don't know where I will get the ADR before the pre-COVID, but if I go back to my spring tension, which rebounds back, I would say I should be back to my pre-COVID ADR for my select service probably first quarter 2022.
So I would tail into that for, I have a pessimistic path to my optimism. So as Dr. Singani knows as well, the idea for me is that the triple plate of challenge in the industry across kind of all platforms is ADR, as Dr. Singani was referencing, occupancy, and length of stay. And if you looked at the length of stay details, that even though you're seeing these, whether it's spring breakers down in Florida or, people running from coast to coast into the center of United States, what you're seeing is that you still haven't solved for not Dr. Singani. I know you can solve a lot of things, but the market hasn't solved for itself for length of stay. And I think that the full select and full service will have a better opportunity to a certain extent in being able to take on that challenge. But if you look at year over year, you went from a high season of 12 to 16 days into 2.1 to 3.2 as a static number, and that is where you're seeing the drive market and the weekend warriors. The market not coming in from Europe is still shut down, which are generally your longer term stay, and your Canadians, so to speak, those travelers are sidelined. And those are the ones that kind of help beef up some piece of that. So, in the concept that we are, still in the pandemic, it hasn't just turned off, so to speak, yet. And this constant rippling effect that you see in, worldwide, I think that has that concept of where, yes, it's a weekend warrior, but my concern is in the later part of this year into next, if this is still the state of confusion. of what you're seeing worldwide, it is going to, I think, fatigue even the people who just want to get out. So you have this current explosion that's kind of happened in the past, call it, I can't even say 6 weeks. I mean, I would hasten to say it, and maybe I could say 4. That in the last 4 weeks, you've seen this massive, pop that's happened, which you saw some moment of it last year for that later summer kind of thing, where people were just, kind of shuffling off in the drive market. But if that drive market doesn't come back and gets fatigued, and you don't have the international traveler and the options, what's going to be next as far as that driver, other than let's just get away for the weekend, and therefore that length of stay issue. And the last point, I'm so sorry, did you put on there, is that you still have hotels that are shut down. So you might be seeing a compression with a reduction of supply in all the markets, because you have permanent blowouts and temporary blowouts that haven't reopened yet.
It's a great point. I'll just be really brief. I hope Doc is right, but I think I agree more with Joe. One of the things that
don't forget, Joe had zero vacancy in his hotels just last 2 weeks. What is he talking about?
No, but he makes a really good point. There are a lot of properties. We still have properties that are closed, right? So there are a lot of properties that are closed. So that's supply that's going to come back into the system. And one interesting point that you make about the length of stay is we're fully focused on full service. There's a full service hotel that has pretty good weekend occupancy in the mid 60s, but the weekly occupancy during the week, Tuesday, Wednesday, single digits. And the problem with that is, to Joe's exact point, the folks that stay the longer stays typically in a full service are fly-ins from overseas, fly-ins from out of town. The weekend drive-in traffic is typically for the weekend. So, and we need that business travel to come back to boost the in-week occupancy.
Gotcha. So let's kind of transition into talking specifically about the investment opportunity that this situation creates. And we're all we just talked a lot about predictions for the future and when we think this is going to come back. So I think a good segue is, how long do you guys think the opportunity, the window of opportunity is to take advantage of this situation from an investment perspective?
Microscopic.
So is that, what is it? 1 day, 1 month, 1 year? What do you think?
No, I think it's going to be, I think the opportunities will lie in the assets that had issues pre-COVID. I think that the assets that have been impaired by COVID that aren't magnificently large. So if you had a 500 to 700 or 1,000, key hotel, I think that, pre-COVID, or you may have had issues, but if you had issues during COVID, the necessity of occupancy to deliver level of service for a franchise and the necessity of occupancy to get to break even is magnificently expensive. And once you start to go over that 400 or 500 key hotel. So, the repositioning or repurposing of some of those and dekeying is probably the one we see for sure as where it's going to be. But I think that the window of, you can definitely get something somewhere between here and nowhere for 10,000 a key if it's, next to a gas station in between the, 2 deserts, you know what I mean? So, that's where, no one's going to be able to drive back to and be driven towards. So I think that's where I would say that if you say it, I think it's months, not years. It's not the early 90s where you could pick up stuff for 10 cents on the dollar. I think that you will have a tremendous amount of pressure in the 2 coastal states of New York and San Francisco. And I think that those are unique geographies compressed by multi-level issues of politics, meaning that the fiscal responsibility of those leaders and what they're doing with those monies, Two, the actual ability to reverse the immigration, the exodus that's happened. And the three, the pressure of the taxes are going to be fiscal issues and those quick recoveries of those. And the last part I would say is the union magnification in those cities, specifically New York.
No, this makes perfect sense. What Joe is saying. Let me give a different viewpoint how the genesis of distress word comes from, and then Euclid has really beaten a lot of people that I know of. Euclid has done huge acquisitions, and love to hear his experience. But just my point of view is, what is distress? Distress is when people just can't make their monthly payment, and then they have to do something about it real quickly, right? Well, let me tell you, ladies and gentlemen, I haven't seen much distress. I mean, the people weren't, just like Joe was saying, in 2007, 2008, people were walking away from hotels and we could get it for next to nothing. We ain't seen anything like that. We haven't been able to acquire literally anything throughout this period. And one of my friend who is a multi-billionaire, he has been acquiring few hotels and he's getting at best 15% discount, 10 to 15% discount. That was he's talking about in the light markets. Now the genesis is people have been missing payments, right? So now divided into two sectors. One is which is financed by non-CMBS debt, and second is CMBS debt. Non-CMBS debt is either personally guaranteed or a relationship with the local bank and stuff like that. They don't want the keys back. They understand this thing, and they, by and large, they worked out the situation with their borrowers. We do have some non-CMBS debt. It was a walk in a park, piece of cake to talk to them. They said, we understand your situation. Let's put this behind. At the end of the term, we do this, blah, blah, blah. We'll skip some of these things. So those people haven't come in the market with distress, nothing like 2007, 2008. On the CMBS side, they've been very rigid. But what has happened in that even they are rigid, it is going to take anywhere between 12 to 18 months for them to take the keys. So you can bark as much as you want, you can call me as much in default as you want, but the process itself for you to take me outside of the hotel is going to take time. And that is the reason we haven't seen much. And wow, right in the middle of this comes PPP twice. I mean, I cannot tell you how many hotels have been saved by just a gesture of PPP. So that's the genesis of how I think where we are today. But that's just one of my theories. But love to hear Nathan whenever you're ready for Euclid to tell his story, because I was fascinated by his story, how he acquired all these assets during the pandemic.
Yeah, let's go right into that. Euclid, if you want to speak to that.
Yeah. So it's interesting because I agree a lot with what Doc said about distress. There are different levels of distress. And one area of distress that we've seen is particularly full service hotels, luxury, upper upscale and upscale properties where the owners have just spent a lot of money, right? We were in a frothy hotel market in 2018, 2019. People levered up and made significant improvements. And there are two things that we're seeing that we've been able to, take advantage of and help existing owners with. One is when the owners are just like, can manage the debt load and the bank is not being patient. So a lot of these, and sometimes they weren't CMBS, they were kind of financial lenders, hedge funds, Wall Street shops that are making these loans, and they want their money. So we've been able to structure transactions where we allow the existing owners to remain in with an equity piece of the hotel. We take over the majority piece, and we're able to buy it at a discount with what's a fair price in today's market, 15 to 35% discount. And it turns into a potential win-win as we ride out of this. The other thing that we're seeing are situations where the bank's patient is running thin. And to Doc's point, they don't want the keys in the middle of a pandemic. And even if we think it's at the tail end, they don't know how to run a hotel better than their client. But if we, as a hotel fund, come to them and say, we like assets in these markets with these specifications, to the extent you have them on your books, we'd be happy to buy them at a fair price. This is how we think about it. They say, oh, wow, that's a great solution. Now they're more likely to start initiating those discussions with the people that have the keys, right? So we're starting to see action on that as well. So we've been able to do 5 deals during the pandemic, and we have a little bit different view of what the buying window is as well, because we think that the buying window, I do agree, it's not anything like 2008. It's not years. It's probably 12 to 14 months is our view. And we believe that the discounts will start to increase during the second quarter of this year. And the reason for that is because those will be bank deals versus lender versus hotel owner deals. So when we're structuring the deal with the owner, it's a lower discount. When we're structuring with the bank, we can get up to a 40% discount.
Wow. So I got a few questions just in response to what you went through there. The first one, and I'm just curious, in the situations where you're coming in and almost kind of, providing a rescue situation, allowing the previous or the original owner to maintain an equity piece, are they keeping, 5%? Is it 20%? What kind of how much ongoing participation are they having?
It depends, right? It depends on the situation, on the asset, but it's been anywhere from close to 50% in one instance, down to, as you say, 10%.
Okay. And are you typically refinancing the existing debt or just assuming it or paying some portion down? Like, how are you appeasing the lender's concerns beyond just you coming in as a stronger entity?
It's a bit of a mix. Sometimes there's a little bit of a pay down if we take on the existing debt, right? And then the fact, if it's been an unflagged property, the fact that we're coming in with a strategy to flag it, plug it into the Hilton system. I don't know if Joe and Doc agree with this, but we view coming out of a pandemic, having a connection to a strong system is going to be an advantage. That the boutique hotel is a little bit at a disadvantage coming out of the environment that we're in. And the lenders have been agreeing with us, right? So we say, look, we have this plan. We're going to flag this. We're going to plug it into the system. We'll pay the loan down a bit, and you have a better credit, right? We're a fund, we're capitalized, et cetera. So that's one way. The other way where we've been fortunate, we're not going to take over the loan. We've been able to through one of our partners, have a $250 million facility connected to our fund with preset terms. So we can go in with 60%, 55 to 60% LTV, reasonably priced debt, because lenders don't want to write a new hotel loan today. That's, maybe they'll give you a 30 to 40% leverage at some crazy rate, but that doesn't help.
I think you're right, though, in regards to the bank's responses of seeing a franchise versus a non-franchised asset. And I think that there's two psychologies to it. One is the definitiveness of the support that may or may not be given because everything's becoming over-franchised in certain markets. But the other side of it is the banks are definitely more inclined to do that because it reduces, in their mind, an operator. When you have the franchise that's there, because there are systems that for them are more dependable, and they don't feel it's the right time perhaps to feel the value add opportunity as much as they are to get to the cash flow as quickly as possible. So the immediacy of that definitely over a longer period of time, we still see that the channels are so commingling on certain assets that your costs. How many Marriotts can you be next to? and have that franchise system still, have an impact. There's markets where we have an asset that we're involved with. We're one of the only non-franchise there. You may need it because you're getting crushed. Excuse me. It's a market by market kind of conversation. But I definitely, as an operator, owner, but from the bank side, you're completely correct in regards to what they want to say.
So, I think Euclid, you mentioned you're looking at both the U.S. and the Caribbean, and Joseph, you had referenced looking at deals in Europe. I'm curious how all of you are looking at, domestic versus international opportunities, and on the international side, is there specific locations that seem more intriguing or more opportunistic than others?
So from our side, the broader global blanket for us is what we call transitional hospitality, where we're looking for deals that have the boutique element, but also we want to be able to offer as much as possible the residential component, where we can be able to rekey, dekey assets, increase the capability for them to have full kitchens and so forth that are utilized on shorter term basis. And that's very location dependent. It's again trying to attack that length of stay asset underwriting that I was mentioning earlier. So that's a big component of what our draw is to any of these markets. We're not looking to be the biggest, hotel owner in US or in New York for that matter. It's really more selectional. But to your specific question in regard to what we see in Europe, I think that the opportunities are deeply distressed in certain parts of Europe, but our drive is to where we have a knowledgeable ability and a basis to be able to make an impact. So that may be skewing some part of my answer. So that's why I kind of preface that. So whether we're comfortable in the UK, Germany, France, or Italy as primary kind of locations, I'd throw Spain and Portugal into the back end as sub B options for where we feel comfortable and we can draw from resources. And being a dual citizen of the U.S. makes a little bit more of a less complicated maneuvering for me. So those are the markets where we feel that there's opportunities. I think that there's deep distressed assets that are there that are way more complicated than the U.S. ones because of labor and because of cost, much more cash component. A lot of these assets require more capital improvements, which are not as easy to determine. Oh, I'll get that done in 6 months. You can look at the U.S. and say, oh, it'll take 6 months, but that could be a year and a half in European time. So those are where we kind of see that as those pieces that are still looking at those longer length of stays. And we're not looking at big deals. It's really geographically located. I would say all of the opportunities are definitely under 200 keys than anything that we're seriously been in discussions on. Locally here in the U.S., I would say sub 300 is ideal. Once you get above that, you start to kind of choke a little bit, but some assets call for it, but I wouldn't run out of the door screaming at 325 keys. I'm just saying where the bulk of that opportunity in fact could be. And you can run them more efficiently. Your occupancy drive isn't as problematic because you're chasing 150 clients, not 500. So your pricing can be more profitable if you manage. The revenue management's insane these days. I will go back to just to kind of touch on what I said earlier of that need to be able to be on the button. That everyone's was used to just leaving the rates out there for month over month, and now with this change in the booking window, it's chasing a stock price in certain markets.
Right. Yeah. So, Euclid, you mentioned you guys were looking in the Caribbean, and I don't know if you can tell from my background here, but I actually sit in Puerto Rico, which is a really unique hospitality market that, COVID or not, I'm very bullish on for a lot of reasons. We could have a whole separate panel on that. But one interesting data point I'll say is that the hotel market here in the last 6 weeks has been going nuts. Rental cars are all booked. Condado's full of tourists, and I think it's primarily because it's a domestic U.S. market, so you don't have to deal with international COVID, flight regulations and all that. So I think people are really taking advantage of that here. But Euclid, where else are you looking here? Are there places in the Caribbean?
Yeah, so we're looking across the Caribbean. We believe that, again, some of the islands have really struggled because of the lockdowns, especially the islands that rely heavily on European travelers. So in some of those locations, you have amazing resorts where the owners are struggling, and we're able to provide a lifeline. Um, I'm not going to talk about any specific islands, but there are situations where, you know, world-class resorts, 70 to 90 keys, amazing locations where we're in discussions with the owners, where there's an opportunity to not only acquire the property, but also potentially add keys. Again, bring a global flag in some of the islands where there isn't a flag and there hasn't been. So that also creates a new kind of demand dynamic and being able to plug into an international system. The other thing that we're finding is a lot of political support, because these islands are dominated by their reliance on tourism. So we're seeing the ability to have all sorts of tax credits and rebates and special deals by the government to entice us to come in and help boost the industry.
Right, makes sense. Let's transition to talking maybe specifically about some economic metrics. And, you know, we've been talking about the kind of discounts we're seeing in the market and whatnot. You know, for each of you, what would really be the minimum discount you need to see to be motivated to deploy capital?
I think that for me, it just comes down to general concept of basis. I don't sit there and say it's 15%, 20%. You know, that's, you know, that's in every market that can mean a different thing. But for me, it's about where is the basis, and when we underwrite, we kind of look at it in these kind of points. Number one, we look at the 2018, 2019 benchmark and say, can we exceed that, get close to it, or what percentage of it based upon the following? We look and test replacement value as a total cost of capital. Two, we include in that to analyze what the carry cost could be for the next 18 to 24 months. And third, in regard to seeing where the supply is in the marketplace relative to before and after, and then come up to where we're comfortable in the basis. So 15% could be right. There's a deal that we were chasing in DC. We felt that the number of close to 20% was right in regard to where that happened to be. But that's not what sells me in regard to doing it. It's really the ground up pieces of those bases to make me understand if I'm making the right decision. If it can absorb all of those costs and still become profitable with a range of best, worst, probable, with that flexibility, that's kind of how we underwrite to it.
So on our side, I mean, Joe does a lot of things very scientifically and very methodical way. I make it very simpler and doesn't necessarily mean better or right.
And you're the scientist.
Right. So the way we do it is, and we haven't been much success either. We are in the process. I was telling yesterday about talking to 2 or 3 hotels that we may be able to buy that under this formula. Is we take 2019 NOI and we just do it 10 cap. And that's a very simple way of calculating what the hell value something at. You know, I had no idea what to value, how to value. And then just like Joe was saying, put all those extraneous factors. Okay, this is a very difficult market to get into. Just give some more juice to that. So few adjustments, but the rule of thumb we are using is take the 2019 NOI and just do a 10 cap. Not necessarily scientific way of doing it, just somewhere to start.
And that's a 10 cap across all markets?
Generally, because some more than the others. Some adjustments, as I said, will occur, but does not deviate. I mean, 10 cap is not going to go to 7 cap because then I'm getting at market, right? Unless I'm in New York or someplace which was crazy pre-COVID, 3 cap and 4 cap, which I would have never bought it anyways.
Yeah,
Unanimous on
so
that.
I think we're probably somewhere in between the two of you. Typically, we're not focused on what the discount is, but we say we're seeing right now 15 to 35% discounts. The way we're really calculating what we think it makes sense to pay for things is we're taking the current NOI and we're projecting a recovery, we think very conservatively, in 24, recovery to 2019 levels. And we're underwriting it to hit our funds return profile. So we're promising our investors a 17 to 20% IRR, and we're running the numbers based on our plan on what the property can do and coming up with a number that way. And typically when we do it, after all is said and done, we look at the number, we look at what the comps were showing in 2019, and it's a 15 to 35% discount. That's what we're seeing.
So I want to make sure we get some questions from the audience. Obviously, we could talk about all these issues for certainly more than an hour. But one question that came up was, how are you going to look at leasehold properties versus fee simple? Is something on a leasehold basis going to affect how you're looking at these underwriting metrics we just discussed?
I think that the vintage matters, structure matters. We have seen, if you looked at the stuff that has been floating around in New York, it was a very public deal that happened in Midtown, where you could get a 285 room hotel for $5 million because the ground lease was so bad. I didn't name the hotel, so I'm not breaking any NDAs. But the idea is that where you look at that as a weighted percentage of your overall revenue is a very expensive proposition. So I would say 85% of the time it's a no-no, unless I'm generating the ground lease going in for some sort of financing, structuring purposes. Or it's part of a master plan development and it's just the way that it's subdivided. So those outliers. But the common concept of where you're seeing these things come in at 25, 35% of your net is a dangerous, invisible partner. So it might work better for a commercial office building, or perhaps a tax structured purpose for a multifamily residential property, and they're generally a little bit more reasonable. But when you see these things with value resets and 2.5% increases per year, that eats up in over 5 years real quick. And what seems cheap money today will be impairing to your disposition value. So forgetting about renegotiating a term, once those things are kind of set, they're like, it's worse than the CMBS structure. You can't get out of it.
No, I fully agree with Joe. And one of my good friend said something which I would like to pass it on to the audience. He said, buying a leased asset is difficult to enter, almost impossible to exit. What that means is to get a debt is very difficult on a leased asset, except some of the outliers that Joe mentioned. And man, when you try to go sell that stuff, it's a nightmare. So I like simplicity in my life. I don't want to complicate it. So I leave that for smart people like Euclid and Joe to handle this. I'll just stay with my normal stuff.
Wait a
fee
minute,
simple.
you're in the hospitality business looking for things that aren't complicated. Come on.
It's an oxymoron.
Wait, I thought this was the triple net lease channel.
that would be really not complicated. You're right.
So we had another question, and this one was specifically for Joseph. The gentleman asked, he was curious how hotel tax implications play into your underwriting strategy as you're trying to optimize for length of stay.
So the question is, how do you optimize for tax strategies in regards to length of stay?
No, I think it was more just how do the hotel, whatever the effect of that asset.
Okay, understood.
Taxes play.
I think that it's part of the gross up of the premium. So I'm not sitting there looking at it and saying, I do look at it to say, okay, it's $5,000, let's say a month, which is a round number, inclusive of the hot taxes. And in the market, maybe it's $4,000 a month, but you're amortizing between that other $1,000, your tax costs, as well as your amortization of your FF&E that's there, which you don't necessarily always get when somebody comes into a hotel room, right? You still have to have a bed, you still have a desk. So I've got a kitchen and a refrigerator and a microwave and a convection stove. So the idea is I'm not looking to utilize this. I think that it's a fast track to embrace zoning versus to try to fight against it. So you have to be able to take into account that, most municipalities are going to treat those nights as hotel nights, which, the person that we're going to be marketing those 40 or 60% of these assets towards are not people who are normally worried about those, $25 a night stays. That's why we kind of stay out of the limited service, because you can't find unique way for us. We want to find unique value-added ways to be able to get people to pay more. And if it's having a kitchen and a vertically integrated ability for families that will remain post-COVID paranoid, and I'm not saying that they shouldn't or shouldn't be, but they want to be vertically integrated to make sure that they can control their food supply, that they can get to somewhere, or if they're coming from another country, that they've now made sure that they're concerned about things. You're hearing more and more concerns about food supplies, more than you are than how's the restaurant on the premises. So look at the things that are there. 60 Minutes did a thing with Bill Gates talking about the fake burger thing. So people are looking at saying, wait a minute, I don't want my family to have this chemically created burger. I want to have it grass finished, grass fed, and I'm going to make sure that that's what it is. So those food supplies and the supply chains and the access to them and the locations that we're at, I think are critically important, more so than that. So it's a long-winded answer to, it doesn't matter to me. If I have to pay the tax, I pay the tax. It's under the underwriting.
Right.
I'm a premium to the residential market anyway.
So I'm curious, obviously all three of you are, looking for investment opportunities. Are you looking for investment opportunities, not only just to acquire something directly, but also on the credit side, whether that's to buy distressed hotel debt or some other credit facility?
Yeah, so we have a partner, a relationship with a real estate focused debt hedge fund, where we partner up and look at CMBS and other notes. We don't want to really play in that space. We're purely focused on the dirt, so to speak, but it's to the strategy I was talking about earlier in the panel. It kind of helps us to have a capital partner that could potentially, if the lender just doesn't want it on their books anymore, take it away. So it is one of the areas that we're playing that is a differentiator.
As far as we go, as some of you know, we have a public company in Israel, and we paid off more than $500 million worth of debt on it during COVID or before COVID. So we have a lot of gunpowder that we are sitting on. that we can deploy. And we are really, I mean, we don't have any particular mandate that it has to be this particular form or fashion, where it's buying the note or buying the asset or buying the credit facility or whatever it is. We have only one rule, as I always try to make everything simple. As long as it's legally and morally correct way, we'll invest if it makes money.
Fair enough. I like that investment strategy. So that's a good segue, and we are kind of running up on time, but this is something just wanted to make sure for the audience's benefit we spoke to directly, even briefly, and that's really just what capital is available in the market today for hospitality deals from both a debt and an equity perspective. If each of you wouldn't mind just briefly, describing what you're seeing available for these deals.
From our side, I'll say that it's predominantly debt funds. I would say that if it's bank financing, you're looking at 35 to 50%. I think that if you're looking at debt funds, you're looking at 50 to 60% in that range. Some of them are getting a little bit more aggressive. You're starting to hear them perk up a bit, but that's a narrow amount and window. And I think the balance is made up of equity and perhaps mezz, which is a very expensive option for the predominant market to be able to absorb successfully.
I do agree with Joe. And just to add to that, I mean, those, even they give you 35, 40% or 50%, 60% debt fund. I mean, you're talking about 9% on the entire slug of money. I mean, I'd rather sell myself if somebody would buy me and then pay the debt then put 9% firstly. In my life, I would have never thought of paying 9% interest rate. So it's crazy, Nathan. I mean, you know it, and you've been just nice to ask us. You know all this better than us. But there is really no debt out there that's meaningful, and then there is really no true equity out there that is meaningful. We just haven't lucked out with all this stuff. So we'll have to just pass through this pandemic, and then things will be fine again.
Yeah, I agree. I mean, the debt's unbelievably expensive and it's low leverage. It's basically no risk paper with equity returns, what the debt's offering you. In terms of equity, I mean, we're out there with equity. We will partner. We do want control. In very rare instance, maybe we wouldn't take control. But yeah, there's not a lot of non-control equity out there either. I've seen a few deals out there where sponsors have locked an interesting opportunity up and they're trying to go out and raise pure, financial equity. And I haven't seen them be successful. We've been fortunate. We've been, raising capital for the fund, but it's partially because we've been able to pre-specify some opportunities so investors can see, it's not just a sheet of paper, a pitch book with an idea. Here's some real assets that we have. It's interesting though. It's not a straightforward market. Other than the debt is straightforward, but it's just bad.
I think that you could hit on something very important in regard to that all three of us are kind of similar in regard to control. For us, it's majority or complete control in regard to the deals that we really want to get involved with for sure going forward. And that's what our investors want as well, and our partners.
So we are running up at the end here, and we've got quite a few questions from the audience. So I don't know if we're going to get all of them, but I want to make sure we address as many as we can. So we'll just start kind of going through these. First question I think is pretty interesting is how do you guys view extended stay properties, relative to the post-COVID world? Are you more bullish or bearish?
From our side, we're definitely more bullish. We believe in that kind of concept, but I think that it has to have that kind of, I think the idea is with the mixed component of boutique, so to speak, and extended stay, I think that that's kind of what we focus on as our winning recipe. I think because the idea is to be able to offer those services and not look like, listen, not to ding the Marriott extended stay product, which is the highest profit margin piece of Marriott. For us, it's disinteresting to do things like whether you're there or in a nursing home, it kind of looks physically the same, except there's, someone changing the sheets more often, but, the idea is that for us, we just kind of see that as ACEs, we're in on that longer term stay kind of product.
Doc, what do you think?
No, again, it goes back to what Joe was saying, that it's length of stay, right? How soon is that going to come back? And then that's one thing. And second thing, I think it's unbelievable where the hospital industry is, and this is much bigger discussion, is we are really blurring the lines between short stay and extended stay. We are blurring the lines between limited and full service and with breakfast and not with breakfast. I think all these things are merging and it's becoming very complex for people to make decisions now. So at the end of the day, you just go look at, say, what the heck the NOI is and what do I project? Because every market is also different. I mean, if you want to do extended stay where I'm in Dallas, where I live, you're crazy. But if you want to look at extended stay in some other areas where most people like to be there, and like Tampa or Orlando or things like that, that's a different discussion. So I think just don't take anything as a God-given truth. Analyze everything that you're going to look at totally impartially.
I think there's an evolution that's happening, and this is coming out of the spin out of the commercial office market. It's where I don't see, office going back to the way that it was. And I think that the reason I'm bullish on it is because the need of this new evolving market segment, whether it's schoolcation, vacation, workcation, it started in its infancy as a bleisure market before COVID. And it's been renamed to these bifurcated three pieces because of the need and the change of people working remotely. And there's people who I know or I've heard with people, the business owners, it's like, I offered the person the job. They were all perfect. They were going to do it. And they're like, well, when you come back post-COVID, stuff like this, we want to get people back into the office, at least 3 out of 5 days a week. Just like, oh, no, I want to work permanently remotely, and turn the job down after accepting it. So I think you've got definitely a split psychology that exists in the world. And I think that there's an impairment that I think is going to stay. I don't think that it's going to fully swing completely back, but I think there's a new market segment that's evolving. That's why we're bullish on it, and we see that that's what it's going to supplant. Well, if I'm not in the office, where am I? Well, I'm going to be down in Florida for 6 months and then come up to New York.
Right. Yeah, we're seeing projects in the pipeline here in Puerto Rico, basically, under that investment thesis.
And Nathan, to your point, it's interesting you mentioned about Puerto Rico. In the last month, we've seen 3 deals, which we haven't seen 0 coming out of Puerto Rico in regard to hospitality. So I'm not an island player. I know Euclid and you are, but I'm not smart enough to know how to be able to handle the hurricanes. And Florida was enough of a risk for me.
Yeah, we don't play in the extended stay space. So I'll leave the commentary to the experts. I think I do agree, though, that it's very market specific, right? Mm-hmm. So for the right markets, extended stay makes a lot of sense. The old extended stay where it was like next to a suburban office park and it was there for the worker to come and stay that's dead, right? That's dead. But what Joe's talking about, that makes a lot of sense to me.
Right. Well, we are running up towards the end of our time here. So first I want to thank all of you for participating. It's been great. So there's so many other questions and things we can talk about, but I'm gonna ask one last question just to wrap everything up. And that's, I'm curious how you guys think about the low interest rate environment that we're in now and likely to be in for some time, while at the same time we have a historically, tremendous amount of liquidity kind of sloshing around the capital markets. How do you think that's going to affect the recovery in the industry coming out of that? Is capital going to really start chasing yield?
I think I'll just take the quick first stab at that. And I think that the idea is that interest rates are going to remain low because we're probably on the brisk of hyperinflation occurring and the devaluation of the dollar. So, I think that you're going to have, for the definitely near term, lower interest rates are going to remain, trying to stave off that inflation. And I think the inflation is going to be hyper driven by external forces that weren't able to take advantage of the U.S. market previously because of, previous tariff thinking. So they want to come back and make up the money they lost. So I don't think that it's going to be, I think that the construction costs were going higher previous to this. 2 years beforehand, every construction project was over budget, whether it was interior or exterior, ground up. I think that you're going to continue to see that progress of those costs increase, and that is going to cause and still maintain a lower interest rate for definitely, in the foresee, I'm not I don't have a crystal ball, but in my crystal ball, I think in the next 3 to 5 years, you're going to see that pretty statically stay low. If it goes up, it's going to throw more ripples that no one else is going to be able to handle.
Right. So, very quickly before we wrap it up here, Doc, Euclid, do you think, how do you feel about the amount of capital chasing hospitality deals in the near future? Is there going to be competition from a capital perspective?
Till the ADR and occupancy, that means RevPAR, till the RevPAR doesn't come back or shows signs to get to pre-2019 level, which we all discussed. Some of us believe it's earlier than other people believe it's later. I don't think capital is going to rush for it, but man, when that happens, there will be no end to it because there's so much capital out there. They're just looking for the yield. And as we all know, hospitality is always difficult industry from risk perspective. I mean, Joe made a comment that it's not a simple business to run. So people run away from it, but as soon as they see the RevPAR coming back, I think they're going to really come back in vengeance. And I just hope Joe is not, unfortunately, he's always, most of the time he's correct, but I hope he's wrong about the dollar devaluation, because I wouldn't like to see that. That would be a death bell for most of us.
I'm hoping wrong. I hope I'm wrong too.
Yeah, I will. I agree. I think that we will see right now. There's not a lot of capital chasing deals, partially because it is a difficult environment. Intrinsically, people think, oh, distressed, there's some great deals out there, but they also know hotels aren't simple assets to manage. So you need to have the skill, the relationships, the track record in the space to really chase deals in this market. So there's not a lot of capital now. Once things start to normalize, there will be. And frankly, for those of us that are buying assets now, that have assets now, that are able to turn them around, it's going to be a tremendous refinancing and recap opportunity when things normalize, because we'll still be in a very low interest rate environment. Banks are in business to lend money. They've been sitting on the sidelines away from hospitality. They're going to see the opportunity to go, and they're going to be throwing money at us at low interest rates, allowing a high level of leverage. And there's going to be more competition in the space, so values will go up. So, I mean, I'm going to touch wood, but I really do think that those of us that
I'm
are
getting
investing,
my catcher's mitt. I want to make sure that when they start throwing the money, I'm not going to miss any of it.
Exactly. No, but I do think that those of us that are putting money in hospitality right now are in for a real valuation uplift and the ability to refinance, have a recap event, and have some very attractive debt 2-3 years down the road.
Right. I couldn't agree more. I think it's a great time to be doing what all three of you are doing. So that said, I think we're at the end of our time here. We got to wrap up. Thanks again, gentlemen. Certainly appreciate it. It's a great discussion, and take care.
All
Thank you so
right.
much.
Thank you.
Guys,
Thank you,
thank you
everyone.
very much.